Welcome to the Allan Small Financial Show. Thank you for sharing some time of your busy day with us. I know how busy everybody is, summertime, going up to the cottage and visiting people. This is the time of year we all like to be out and about. So really thank you for joining us today. I always like to start the show by talking a bit about why we do this show. What's the purpose behind it? And simply put, it is to talk to as many Canadians, Ontarians, Torontonians as we can, share a little bit of information with them, talk a bit about what's going on in the world today of economics, finance, and the world of investing. And we want to answer your questions live, whatever questions you may have. At the end of the show, I will attempt to answer as many questions as I can. Please send us your questions through, if you're viewing through YouTube or Facebook. I'll take any questions that you have. And if I can't get your questions today, I gladly will try to answer them before the next show or maybe even on the next show. We try to do this show every couple of weeks. I will say that the next show will actually air 3 weeks from today on August the 17th. August the 10th, I actually will be away. So the show will air 3 weeks from today, not the regular 2 weeks. And basically, it's always at 12 noon and always on a Wednesday. So without further ado, let's get into the show and tell you a bit about what we're going to see on today's show. On today's show, we're fortunate to have a great guest, Jonathan Chevreau. Jonathan has had a great career of interviewing some of the best names in business. He truly has his finger on the pulse of what's going on. And so we will talk markets, talk interest rates with Jonathan Chevreau. We'll also do our regular segment, which is our This Week segment, where I talk about what individual investors should consider before they make their investment decisions over the next 5 to 10 business days. We'll also speak a bit about kind of a theory that's been going around, a theory about how the Federal Reserve and maybe even the Bank of Canada could be cutting rates second half of 2023 or next year, even though they're raising rates so aggressively currently. And then we're also going to talk a bit about what you should be asking an investment advisor when you interview them to be your investment advisor. What makes a good investment advisor? And what questions can you ask to tell if your investment advisor or that investment advisor has their finger on the pulse of the markets? And lastly, I will answer your questions about anything, about your individual portfolios, about economics, about what's going on with inflation, interest rates, whatever questions you may have, I'd be happy to answer them. So let's get on with the show. I'd like to welcome Jonathan Chevreau to the show. Jonathan is currently the investing editor at large with Money Sense magazine, and many of you may recognize him from the personal finance column that he wrote for the Financial Post newspaper for 19 years. In addition, he's an author and founder of the Financial Independence Hub, which describes itself as North America's gateway to financial independence. I'd like to again thank Jonathan for joining the show, and welcome to the show, John.
Thanks for having me, Alan. I'm looking forward to it.
That's great. That's great. So, John, I thought I'd start by asking you the question. I know you interview a lot of people. You talk to a lot of people. You have definitely your finger on the pulse of what's going on out there. What do you think is making these markets so jittery? Why do you think we're seeing such volatility in the markets? Is it interest rates? Is it inflation? Is it something else? What do you think is really causing these markets to gyrate as much as they have been over the first 6 months?
Well, I think you yourself tackled this topic of inflation, interest rates in one of your recent Money Sense columns, and a lot of us have been as well. You just look at the classic balance fund, the asset allocation ETFs, the Vanguard's VBAL or iShares XBAL or BMO ZBAL, all the same thing, 60-40. It's the first time in 40 years that both sides of the barbell have been down in 2022. So usually if stocks go down, you feel compensated in the balance fund because the bonds are up. Of course, this year, because of the interest rates going up, bonds are going down. So it's pretty unprecedented. And no wonder investors are nervous. It almost seems like there's no asset class where you can safely hide. Although I would say that I'm about on my hub to reprint a thing on Vanguard. Recently put out a post saying that rumors of the death of the balanced ETF or balanced fund classic are exaggerated, and they expect it to rise Phoenix-like very soon. Let's just hope so.
Yeah, and we talk about nowhere to hide, and obviously, I think a lot of that has to do with rising interest rates. And kind of let's move on to that topic. Interest rates have been on the rise now for the first six and a half months of this year. We've gone from a prime rate of just under 2.5% to a prime rate now of 4.7%. Interest rates, have been moving quite rapidly. The Bank of Canada, even the Fed in the United States has been raising rates. Do you think that they need to continue to raise rates as fast as they have been to get this inflationary pressure under control? Do you think this is the best path for them to go forward?
Well, if you believe in the 80s and Volcker in the States, I mean, at one point in the 80s, interest rates were close to 20%. I even remember a time when my mortgage was 12%. And at that time, I mean, that was quite a shock to the system. You remember the Arab oil embargo and all that sort of thing. So I think they do need to raise. I fully expect them to raise another 75. Perhaps the Fed today will be raising 50 or 75 basis points. The Bank of Canada last week surprised people with 75 basis points, where people expected 50. So I'd expect at least one or two more rounds for the rest of this year. After that, maybe things simmer down. Obviously, if the market starts to really get bad, but last I checked this morning, tech stocks in particular were up on Microsoft and Google's relative optimistic performance. So that's good. But certainly people are on tender hooks. But the thing about interest rates being rising, it's not all bad news. It's bad news if you're a young person trying to get into an overpriced Toronto or Vancouver real estate market. The price of the houses is really high, and all of a sudden it's going to cost a lot more to you're no longer having practically 0% financing. But on the other hand, for people like myself who are semi-retired and retired, for years it's been frustrating because going back to the classic balance fund, you wanted to get some decent returns, not just on the stock side, but on the bond side. And when you were getting 1% on a GIC or something, that was pretty frustrating. What I would call financial repression on the part of the central banks. Now, since last week, if you go to places like EQ Bank or Oaken Financial, you can get a 5% on a 5-year GIC. So I think that's actually good news for somebody who's wanting to take less risk in the stock market. I mean, you have to have, with this inflation, 50 or 60% in stocks, I think. But if you really value having a bit of a buffer, then it's time to. I think personally, I do still invest in GICs as well as bond ETFs. Bond ETFs have been hammered, as you know, particularly if you're in the longer term ones as opposed to short term bond ETFs. But whereas GICs till recently would have been prudent to be in 1 or 2 year terms, hoping that you can cash in when they do raise rates. Well, now they have, so it makes sense. I think Rob Carrick at the Globe just last week wrote a piece saying it was time to build 5-year GICs. I think Gordon Pape has written the same thing. So it's not all bad news. It depends where you are in the financial life cycle.
Yeah, no, for sure. And I was fortunate enough to be on with Gordon Pape Zoomer show with Libby Znaimer, I guess about a week and a half ago. We actually spoke about that, where GICs are now a lot higher. Obviously, with inflation running at 8%, owning a 4 or 5% GIC, unfortunately, doesn't really get you any further. But at least now your retirees and those that need that fixed income could actually get a higher rate. I just worry, I guess, from my perspective about raising interest rates. I guess my commentary for the last little while, and it's funny, Elizabeth Warren, senator in the U.S., actually echoed the same statements this morning. Not often I say the same things as Elizabeth Warren, but she was saying how she doesn't believe raising rates is going to fix the inflation problem. And I agree with that. Eventually it will, because it will slow down everything to the point where you'll have a very large slowdown in the economy, perhaps even taking us into a recession, which many people are fearing, and obviously the stock market as well. But when you look at the main problem, higher oil, labor issues, higher commodity prices on some goods, these are things that, unfortunately, when you raise interest rates, in my opinion, they just don't fix the problem, right? How can we get China to open up, from their zero COVID policy sooner by raising interest rates? Or, unfortunately, the whole situation, Russia, Ukraine, with the oil and not enough oil in the world right now. These are issues that, in my opinion, have caused the inflation rate to perhaps, double, from where it probably would have been had we not seen a war in Ukraine. So it's unfortunate, in my opinion, that we're seeing these inflationary pressures as we are. A lot of them can't be held, or I guess can't be fixed by the Fed raising rates. But that's the only tool they have, like you said, in their bag, and they will use it. They will slow down the economy and eventually slow down inflation. And so I guess the next question I go to is, with a slowdown in the economy and seeing some of the reports we have seen recently, some of the big tech stocks like Microsoft, Google reporting what I would call mixed results, not too bad or not as bad as anticipated, but not great either, lends itself to some really good bargains out there. Do you think that the savvy investor could take advantage of some of these bargains that we're seeing out there? Some of these stocks are down 25, 30 plus percent. I think there's a lot of opportunity out there for someone looking for growth in their portfolio.
Well, if you look at the Cathie Wood's sort of innovation stocks, a lot of them, I know because I own some of them, are down 70%. If you're talking about any of the pandemic plays, Shopify in Canada, it's just been hammered. We all know. So going back to, I think we did have markets topped out last November, and I think it was in part it was because interest rates were left lower for longer, too low, artificially low, I would say. And I think that we had that basically a bubble, certainly in the innovation stocks. And cryptocurrency is another good example. That's something that's gotten slammed as well. So ironically, crypto was billed as sort of an inflation hedge, well, as was gold. Neither of them have done very particularly well. Yeah, since inflation crypto has been hammered in half. In fact, you talk about Zoomer. I wrote a piece for Zoomer magazine myself on this very thing on crypto. So personally, I again, if you're an older investor, I think you want to go back to that balanced portfolio. I mean, now is not a time to sell the balanced funds or even bond ETFs. That would be selling low. You want to buy low, and I think right now balanced funds is an opportunity. So I would be, quality dividend U.S. paying stocks, or the Canadian oligarch stocks like the banks, the telcos. We saw the power of the telcos when Rogers was down for a day or two. You realize how dependent we all are on the internet. Yes, sure. And then you got your pipelines and utilities. There's a lot of good a la carte, must-have stocks right here in Canada, which probably should be held in your TFSA or non-registered, keeping your RSP for U.S. dividend payers. So I think it's a good time to buy quality when it's on sale. I certainly wouldn't be jumping in to buy the Cathie Wood stocks right now. Maybe very small flyer, averaging in very slowly. Me personally, I try a little bit of ARK itself, ARKK. Why buy the underlying when she's pretty good job at bottom fishing.
Yeah, no, for sure. And we know that 90% of a person's return definitely come from asset mix, not necessarily which stocks in particular, but the asset mix itself. And I guess lastly, before we let you go, I know you published a survey on your financial or Findependence Hub. This was a survey, Scotiabank survey, talking a bit about how individuals are definitely a lot more concerned about what's going on and how it's hitting certain segments of the population harder than others. In terms of they're concerned about the inflation, how it's affecting them. What was your main takeaway from the survey? What did you see, and what stood out to you as most important with that survey?
Well, I think the survey confirms what most of us know. If you walk into a grocery store, you'll know the price of everything. I mean, we like to have fish, salmon, for example. Well, that's way up. Or more mundane items like just vegetables and cauliflower, you name it. Or the other phenomenon is shrinkflation, where you think you paid, oh, the price hasn't really gone up, but they just took my cereal box down in size by 20% in quantity. So I think these are visceral. The gross. I mean, ironically, I believe Loblaws has done very well as a stock in Canada during this whole phenomenon in 2022. So it goes back to how do you protect yourself against what appears to be just steadily increasing costs. So you pretty well must have stocks. When we went to fixed income, I think I would like to mention TIPS, in the U.S. Treasury inflation protected securities or real return bonds in Canada. They were kind of overpricey before. You had to pay a sort of premium to have inflation protection. But now I think that protection might be there. You can't be your cake and eat it too. You talked about the problem with GICs, even at 5%, that they're not really matching inflation. True. But if you can get an inflation-linked bond or an RBB or an ETF that owns them, like this Vanguard VKIP, for example, in the state, then you can have sort of the best of both worlds. So personally, I think the balanced fund is going to be, as Vanguard says, sort of on resurgence. If you buy the funds when they're down, whether it's because the stocks are down or the bonds funds, historically, things like VBAL and XBAL are up. I think they were up 10% in 2021 before they started to come down again. There it is, your classic buy low, sell high opportunity.
For sure. And now that interest rates have risen, obviously the balance fund becomes even more important. And I think it can finally give that balance, as the name implies, right? Not, balance funds, not just a whole bunch of stocks in it and a few bonds. Now you can start to see more bonds in these portfolios. So thank you, John, for being on the show. I want to thank you and thank you for your knowledge and your expertise. And I look forward to seeing you again down the road.
Just give me a call. Thanks a lot, Allan.
All right. Take care. That was a great interview. A lot of insight from Jonathan Chevreau. Great. This is the part of the show now where I talk a bit about what I believe is important for individual investors to consider before they make their investment decisions over the next 5 to 10 business days. I want to touch on a few things. I want to talk a bit about the Fed. The Fed is about to raise interest rates, I guess, in a few hours. What does that mean for the markets? I want to talk a bit about corporate earnings. How have they been so far? And what can you expect over the next few days when we see some big names like Apple and Amazon report earnings? And lastly, economic data. We've already seen some economic data, or we received some economic data out of the US earlier this week. The biggest, piece of data is yet to come, which is Thursday, when they're going to report GDP numbers. What is important about that? And what should we expect, and how will it affect individual investors? So let's take the first one. The Federal Reserve is going to report, or at least make an announcement at just after 2 o'clock. They're anticipated to raise rates about 75 basis points. That's what we thought here in Canada when the Bank of Canada last had their meeting. Could they surprise us with a full percentage point increase? I'm not sure. I think the markets are betting more so that they're going to go 75 basis points. And if they do, perhaps the market will take that in stride versus raising more than expected. I think overall, I think that the Fed, whatever they say in their press conference after, is going to be probably judged more so than their actual announcement itself. Are they seeing inflationary pressures starting to abate? Will they see the inflation, or do they predict that inflation will start to slow down or cool off? I know we're seeing inflation cooling off, or at least some indicators telling us that inflation is cooling off in certain segments of the economy. So very interesting to see what the Fed says today at 2 p.m. Corporate earnings season has kicked off, and in my opinion, it's actually been better than expected. We've started to see some names on the Canadian side. We see CN Rail, Rogers, Shopify, slightly disappointing, although stock is up today. We've seen in the US, we've seen bank earnings. We've now started to see some of the biggest tech names, Google, Microsoft, Netflix, and really the results have been mixed. I think the most important takeaway for me is that when we do see a bit of a miss, like we saw last night with Microsoft and Google, or Alphabet, I guess, as it's properly called, stock market actually is not selling off. If we would have seen these misses in quarterly earnings back in March or in April, you probably would have seen the stock drop 10, 15%. Yet we're not seeing that now. And in fact, Microsoft and Alphabet or Google were actually higher this morning after they reported earnings. JP Morgan had what I thought was a very soft report, and their stock, I think, fell 1, 2% only. So perhaps we are closer to a bottom in the stock market with these individual names than we are anywhere near a top. And so maybe this is a time where individual investors should start looking for some of these names on the cheap. And I've talked a bit about this in some of the places I've spoken, whether it's BNN or other places like that. I think we are closer to a bottom than perhaps many people will give credit for. So let's continue to look at corporate earnings going forward, especially this Thursday when we hear from Amazon and Apple. Lastly, the third topic is economic data. As I mentioned, we've already received a lot of the economic data for the week out of the US. We're going to receive on Friday some income and spending numbers, which is, I think, key. But most important, we're going to get a GDP number. Now, the first quarter in the US was the first negative quarter. And if we were to see a second back-to-back negative quarter for GDP or growth out of the US, that would tell us that we are officially in a recession, because that's the definition of a recession. We saw some economic data in the US this morning, and that leads me to believe that we may skirt by and not have a negative number in the second quarter and therefore not be in a recession. But it'll be very interesting to see what they report on Thursday when we get that GDP data. If indeed the US is in a recession, will the Federal Reserve continue to increase interest rates as aggressively as it has, knowing that the country is in a recession? We'll have to stay tuned and watch for that number. Interest rate cuts in 2023. What a concept. Here we are talking about how fast the Bank of Canada and the Federal Reserve are raising interest rates. What would possess them to cut rates in 2023? Well, interesting enough, there's such a thing called the Fed Funds Futures, and that is basically an indicator to all of us where the market believes that the interest rates will be in the coming quarters, coming months, and coming years. And they've actually, or this Fed Funds Future is actually already pricing in an interest rate decline in the back half of 2023. You can see in this chart how fast interest rates have gone up in 2022, but it's pretty much been a straight line higher. So to me, what the market is saying is that the Fed is going to overcook it. It's going to overdo these interest rate increases, so much so that they're going to have to lower rates to stimulate the economy in 2023, that we could see at least a mild recession, very shallow and mild recession that may last for only a brief period of time. But in 2023, the markets are already pricing in a cut in rates. To me, with everybody questioning the credibility of the Fed and the Bank of Canada, I think if they have to cut next year, that would cause us to question their credibility even more if the Fed were to cut. So hopefully they don't put us into a recession, the Fed, Bank of Canada. Hopefully they can have a nice balance of rising rates and keep it so that, yes, things may slow down so we can bring down inflation, but we're not going to slow down the growth. That we will slow down the growth, but not take us into negative growth. So that maybe instead of seeing, high growth rates, we might skirt by with a 1-2% growth rate. And I guess that's really the hope of all individual investors at this time. So I know we're getting close to the end of the show, but I wanted to touch on a few things or an idea or concept before we get to some questions. And it's all about what to look for in an investment advisor. And I know a lot of people watching today, you're always wondering, is my investment advisor looking out for my best interests? Are they what should I be asking them to find out if they're doing a good job for you, the investor? Really, I think it comes down to one main thing. Obviously, you want your investment advisor you want to feel that they're looking out for your best interest. You want them to be accessible. You want them to have the answers to the questions, have their finger on the pulse of the market. So there's a whole bunch of things there that I think you need to have or feel that you have with your advisor. But I think your advisor, I think more importantly than anything, I think they need to have a plan. I think they need to have a plan during times of volatility. What is your advisor saying to do or recommending you do during today's market when everything is quite volatile and we're seeing the ups and downs like we haven't seen in quite a long time? What did your advisor do in the fourth quarter of 2018 when interest rates were rising and we had similar issues? What were they saying in 2008 when we had the financial crisis, or in the late 90s when we had the tech bubble burst on us? I think individual investors need to have a plan. They need to have a strategy. They just can't run and hide and just tell you that, oh, eventually things will come back to normal and just hold on to what you have. They need to be there for you, and they need to explain what's going on, more important than anything. And you need to feel that they're there for you and have the answers and have a strategy for you when times are tough and volatile. So in my opinion, that's what you need to be asking your investment advisor. What is your strategy when times are tough? And I think depending on the answers they give you, I think that will go a long way as to whether you feel as though you're comfortable with the advisor sitting across the table from you. Now's the best part of the show. I love this part, where I get to take some of your questions. I see a question here. Let's see here. Talking a bit about, I guess, someone's asking me about customized portfolios. What's your take on that? I guess this person knows me a little bit and knows that that's what I do. I prepare customize or prepare portfolios from scratch. So they're mentioning on the chat here. And yeah, that's what I do. I talk a bit about building portfolios from scratch to meet the needs of individual investors. I don't really have a cookie cutter approach. I don't have any preconceived or created portfolios that I just slot people into if you're low risk or medium risk or high risk. I build portfolios to meet the needs of the investors sitting across the table from me right then and there today. And as we know, with volatility as high as it is, building a portfolio today will look a lot different than building a portfolio, even just a few months ago. So very important to build portfolios, in my opinion, from scratch to meet the needs of individual investors. Also, seeing another question here. Listening to you Thursday at Money Show last weekend on News Talk 1010. You were talking about how much one needs in order to retire. Can you please elaborate on this? How much do you think is enough, and how does one get there? So the question basically is, how much do you need to retire? And get that question quite often, because I think a lot of people look for this magic number. Oh, you need $1 million to retire. You need $500,000 to retire. Obviously, it's all going to be dependent on you. How much do you need? What kind of lifestyle you want to lead in retirement? When are you retiring? Are you taking early retirement? You probably need more money than someone who plans on or is retiring later in life. What's the inflation rate? That will play a big factor into the calculations that we make with respect to what you need to retire. So all this factored in. And lastly is you, the investor. What kind of life do you want to lead? And so it's not so simple to say you need $1 million to retire or you need $500,000 to retire. We want to calculate it. We want to create a financial plan. And that's going to basically tell you, well, if you do this, this, and this, if you average this sort of or this rate of return for this period of time, factoring taxes, factoring in inflation, this is the number that you get. And then it's up to the individual investor to figure out, is this good enough? Do we need to make this better? Do we need to retire later? Can we retire early? And I think really once you look at the numbers and have the facts in front of you, I think the individual investor can be better equipped to make an intelligent decision. Let's take try and squeeze in another couple of questions here. With interest rates going higher, is it time to move out of equities and more into bonds and GICs? Great question. Jonathan and I spoke a bit about the fact that GICs are paying a lot better right now. Bonds are paying a lot higher interest rates right now as well. What we didn't touch on is the difference between a 1-year rate and a 5-year rate actually is very, very little. So you probably don't have to buy a 5-year bond or GIC to get a 4% interest rate. You probably can buy a 1 or 2 year fixed income product like bonds or GICs, and that would be almost as good as buying a 5-year, and you're going to have a shorter maturity or shorter time to maturity. So I think looking at a different asset mix at this point is starting to make sense now that interest rates are higher. For the longest time, we used to say TINA, there is no alternative to the stock market. TINA, no, there is no alternative. And now I think there is starting to become a little bit more of an alternative for those that are looking for a decent interest rate. So I think, yes, I think you can start to look at bonds in particular, corporate bonds in particular, as part of a diversified portfolio. I know we're coming up on roughly 30 minutes. I'll try and take a last question here. How do you measure success with your clients? And I think that's a great question. And I think it's an easy answer, actually. I measure success for my clients when my clients are able to say that they've reached their financial goals, simply put. And that could be on an annual basis. It could be every few years. It could be at the end when that client is ready to retire and sail off into the sunset and enjoy their wealth. But I think how I measure success is if clients are happy and reach their goals. And setting expectations is key, is huge for that. We want to set the right expectations for the portfolio that we're building so that individual investors know, well, based on the portfolio Allan has built, I should expect a rate of return of a certain amount. And if that is not met, then we need to discuss it, perhaps make changes. Sometimes we make more than the amount that we're targeting, and sometimes less. But over the years, over the longer term, we know that medium risk portfolios should make a certain percentage, whether it's 7 to 10%. The low risk today might make you closer to 4.5 now, whereas before it might be 1 or 2%. So we need to have the right expectation. And when you set the right expectation, in my opinion, that sets you up to be satisfied and basically success for the life of your investing. I know we have a couple more questions, but I think we're out of time. I want to thank everyone, as I said right off the top of the show, for sharing some time with us today. I look forward to seeing you all again on August the 17th, so 3 weeks from today. I wish everyone a great 3-week period, and let's go markets. Hopefully the markets can continue to move higher for the rest of the month and into August. Have a great afternoon.